Okay, we are live now. So I think the link is on. Hello.
Hi.
Welcome. So we are on YouTube Live already.
Oh, perfect. I see.
Okay. So I think we're just waiting for more people to show up.
Okay, excellent. Hold on.
Let's see. I'm making sure the streaming is working. Yeah, it's working. Yeah.
Okay. Should I also try to share my screen and test
Yes,
that?
you can, Hocam.
Yes, please.
Yes, please. Yep.
Okay. You see my screen?
Yes, looks fine.
Okay. Perfect. There is only one thing in terms of the logistics that I should warn you about. I mean, I moved to I'm in a different apartment, and I'm not 100% sure about the stability of the internet here. I've seen in the past that occasionally I lost it, and then when I restart the modem, it comes back in a minute. So if that happens during the seminar, I might be gone for a minute or so. Okay, I will reconnect if that happens.
That's fine.
Okay.
On campus, we have similar issues from time to time, so it's okay.
Okay, sounds good.
In fact, we have some construction going on, so it's very likely that we'll be the one leaving for a while.
Oh, okay. Okay. How long is the seminar, by the way?
90 minutes.
90 minutes. Okay, that's good. So how are things in Ankara?
Well, not too bad. Actually, we started teaching the hybrid mode. So one day we are teaching online, one day we are teaching face-to-face. But you know, we are getting used to this new world order, maybe I should say. But
world order. That's a big word.
We are all trying to adjust to it. Yeah.
Do you have full online courses, Alp?
I'm not teaching this semester, but last semester I taught online. Yeah, so it was kind of we switched from offline to online when the shock hit, and then it was fully online. And I think both Chicago Booth and MIT have the econ departments have basically fully online courses. I think some other departments have like kind of offline instructions, like the ones that would benefit from offline instruction, like labs and stuff like that. But for economics, I think the cost of going offline is relatively low. So most courses that I know are offline, so online. How about you? Do you do like mixed, or do you do offline, or
we started the hybrid system. So one day we go to school and we do online teaching in the class.
I see.
And the students can just drop by, but they can also, follow you at their home. So it's a hybrid system.
I see. Oh, that's good.
Yeah.
It must be difficult, right, to do a classroom and then while you get also the Zoom.
Yeah.
Super difficult.
I can imagine that. Yeah.
All right, Burçin hocam.
Yep.
All right, that's your show.
Okay. I think we are ready to go. So we are very happy to have Alp Şimşek from MIT. We are very pleased to hear his paper on monetary policy with opinionated markets. We have 90 minutes. Vehicle.
Teşekkürler Burçin. Uzaktan da olsa size katılmak güzel. I'm going to switch to English now. So this paper is joint with Ricardo Caballero from MIT, and I am visiting Chicago booth this year. And this paper is motivated by the following observation. The central banks and financial markets seem to regularly disagree about the expected path of interest rates. So this figure, the dots in this figure here show the so-called the dot curve, which reflects the FOMC members' average prediction for future interest rates. So the Fed's average prediction for future interest rates. And the solid lines show for the matched FOMC meetings, the financial markets prediction, the so-called the forward curve, the prediction revealed in futures prices. And you see the two curves rarely line up. There are actually big gaps. And of course, you need to do some adjustments to this figure. For instance, you might think about cleansing the market forward curve from risk premium effects. But the people at the Fed who have done that carefully find that actually large gaps still remain. And alternatively, you can think of measuring the market's belief from survey data instead of price data, let's say using blue chip forecasts or survey professional forecasters. And if you compare it with the Fed beliefs, let's say in the green book assumptions or the dots, you see actually even with sort of survey data, large gaps remain. And in fact, this is not even a US specific phenomenon. In other countries where central banks release their interest rate forecasts, you see similar disagreements with the differences between financial market forecasts. So we think this represents a puzzle from the perspective of the existing literature, because the literature is heavily focused on information asymmetry and signaling effects. So the idea is the Fed might have superior information about its actions or about the economic activity. And the issue is how to credibly signal that information to the public. While that's important, we think that's not a great starting point for understanding the picture that I showed you, because, for instance, the market data that I showed you is for after the dots are released to the public. So the Fed says, look, this is the interest rate we expect to set. And after seeing that, the market still disagrees with the Fed. So that to the extent that there is some signaling, it doesn't seem to be very effective. We think instead, these gaps point to genuine opinionated disagreements between Fed and financial markets about what's going to happen. And I'm going to show you later some empirical evidence from among financial market participants that support this type of opinionated disagreement. But there is also a lot of anecdotal evidence that suggests financial markets actually regularly disagree with the Fed. To give one example, consider the December 2007 meeting. In that meeting, actually, that was the run-up to the financial crisis. The Fed cut interest rates by 25 basis points, but the markets were expecting a bigger cut, so that this ended up being a hawkish monetary policy surprise. The stock markets declined and so on. And if you read the newspaper coverage of this meeting the day after, you see actually the markets thought the financial conditions were going to deteriorate and then the economy would become weaker. And they thought the Fed didn't understand the scope of the problem and made a mistake. For instance, David Greenlaw says from talking to clients and traders there's in their view no question that the Fed has fallen behind the curve. There's a growing sense the Fed doesn't get it. So that doesn't feel very deferential to the Fed, right? Instead, that suggests confident or opinionated disagreement. And we, motivated by these observations.
Can I jump in? Sorry.
Sure, of course.
I'm just a quick question. Which one turns out to be right? Did you look at the performance?
That's a great question. I think there are some papers that analyze the performance, and I think you don't see a clear winner. I mean, but I haven't done a sort of a very detailed analysis of this. When I looked at it, I found the Fed was less biased, but then had bigger variance. But I think other people find different things. But for our results, actually, who is right is not going to be very important. Disagreement is going to be driving everything. But I think that's an interesting question, and there's a literature about that actually, that people look at the relative performance of forward curves versus the Fed. I think actually, I remember now, the one paper finds the markets do a little better, but there's certainly not a big difference between them.
So I think there was this discussion a few years ago whether the dot plot is valuable for people to understand what the reaction function is, and there were a lot of people who were disagreeing with the fact that, oh, you're looking at the dot plot, you're trying to infer something from it, but there's nothing to be inferred. And there were a few press conferences where Janet Yellen, I think, and at some point Jerome Powell, at some point he said, and Janet Yellen said, you're attaching too much weight to the dot plot, and maybe you should not even take a look at it at all.
That's a good point. I mean, I don't want to hang our case on the dot plot. Actually, if you use Green Book, like the assumptions that go into the Green Book that the Fed staff prepares, that's sort of the Fed's best guess for the staff's best guess for, because I think that the question, sort of the background to your question, is that there might be some politics going into the dot plot. Maybe they say what they want to happen or what they want. I mean, it's true. But if you, for instance, look at the staff's predictions, you still see big disagreements with the market. Or you can look at other things. I mean, at some level, it seems quite natural to me that there is disagreement, because even if you look at among the dots, you see big disagreements. If you look at among the market participants, there's big disagreements. So it seems to me that actually the knife edge case is to assume the markets and the Fed agrees, right? But that said, I agree. The dots might not fully reveal, but I think the disagreement is a much more natural and much more general kind of assumption to make.
Alp Hocam, there are several issues here. One is, I believe that the central banks and markets have differences of opinion. And at some point, I will want to ask you why those differences of opinion arise to begin with. But neither the dot plots nor the Green Book are outstanding places to look, because the Green Book, by law, cannot provide suggestions to the policymakers. They can't advise. And so the Fed economists work under the constraint that they always have to produce as flat an interest rate path as possible that is consistent with their macroeconomic predictions. So that path has to be wrong. And in fact, deep down, they might be agreeing with the markets. They just can't show it. There is a nice paper by Ellison and Sargent.
Yeah.
Yes, right. Some would know. That says the dot plot suggests the policymakers have maximum preferences. They are very afraid of, not being able to deliver the growth or miss inflation on one direction, and therefore the dot plot doesn't reflect their beliefs either. So another interpretation of what you see here is simply that the Fed policymakers and economists and markets have exactly the same beliefs, but the Fed people, economists for one reason, policymakers for another reason, have incentives to misreport their beliefs.
I agree with everything you say, that the dot plot and also the Green Book might be confounded. I mean, I wouldn't okay, there's a question of how you measure the Fed's belief. But I disagree with the conclusion you reached, that they and therefore should agree, because look, when you say that they should agree with the market, it's not even clear which because even within the market, I'm going to show you some evidence. There's huge disagreements about future interest rate.
Fair. Very fair.
I mean, so I think the question is a measurement. How do you measure the Fed's belief? And I think that's a serious question. But I don't think the conclusion has to be that they therefore, because we cannot measure that. I don't think that's the case. And I think there is something as a Fed institutional belief, or at least sort of interest rate that they will end up setting, which aggregates, by the way, their internal disagreements and so on. And we don't measure it very well. And I agree with the problems, but we also think, I mean, taking the dot value at face value, yeah, is not a great assumption. It's also not a terrible assumption, right? So you might as well, I mean, those other frictions kind of on average net to zero, you might think that is something. So, but I take these points, okay? So this is going to be more like a theoretical paper. We're going to start with the presumption that there is disagreement and see where it gets us. And I think there's a measurement or quantitative paper to be written on these.
Let me throw in a question that you may answer anytime you want to. So, Sang, Burçin, Hakan, and I are working on this central bank information business, and think in terms of information asymmetries. You have a symmetric information, but opinion asymmetries framework. And information asymmetries are easy to motivate. Opinion asymmetries, in the absence of information asymmetries, are not very obvious to me. What is it that makes the two of us look at the same data, and one of us say interest rates should go up, and one of us say, no, they won't go up, or they shouldn't go up?
Okay, that's a great question. I guess there's a bit of a taste difference, because to me it sounds very natural. I think if you just pick two random people, they would rarely agree on anything. And if you think about the deeper sort of micro foundation for where these things might be coming from, I think they reflect on kind of differences in underlying frameworks. Like sort of you think certain data is more informative than others, whereas the other guy thinks like. So you can actually microfound this in a model where we see the same information, but we put different weights on different sources.
But in that
why you do that? Well, that's like maybe overconfidence. You think this is more informative, and I think that's more informative. But essentially, as long as there's some differences in the underlying framework, they emerge quite naturally.
But this is true. But it's not then clear to me that these are just differences of opinion in the following sense. If we put different weights on different pieces of information, then we have different forecasts of the fundamental variables too. It's not just a difference about what interest rates will be. It really is a difference about what inflation will be, and therefore what interest rates should be. I
agree. It's exactly the assumption that we're going to make. So, I mean, interest rates are endogenous outcomes. So we could just say, all right, but that wouldn't, so the whole point of the paper is how you go from disagreements on more fundamental data, like, we're going to make them disagree about aggregate demand. So, which something that moves the economy, spending in the economy. If you want something very concrete, think like consumer sentiment. So they're going to disagree about something that drives aggregate demand, and they're not going to be completely crazy. Actually, they're going to learn from the data. So eventually, the disagreements are resolved. They see the data, they update. It's just that they don't think the other guy has any information that they haven't incorporated already. Okay, so those are the assumptions that we're going to start with, and we're going to, just like Refet, so we're going to show how this naturally predicts into disagreements about interest rates. And more subtly, we're going to show that actually these disagreements also matter for optimal monetary policy. They help you to understand not only the expected interest rate, but also the current interest rate, assuming that it is set optimally by the Fed under the conventional framework. And in extensions, in fact, I'm going to allow for information asymmetry as well as disagreements. And we're going to find that our results are robust as long as there is some disagreement on top of signaling. But also, actually, this extension, we find that monetary policy announcements actually can feature either the conventional monetary policy shocks or information effects. And the model helps you understand when you have one or the other. It also helps you understand, I think, in a deeper level, what that conventional monetary policy shock is. In the literature, it's like the Fed wakes up and increases the interest rates. In our model, that's going to actually happen for a reason. Okay, so, and finally, we are going to also consider heterogeneous sensitivity to data, which actually, if you think about heterogeneous beliefs, it's also quite natural to think that people might also learn from data at different speeds. Some people the Fed might put more weight on the data than the market. And we find that that dimension of heterogeneity actually has important implications too. In that kind of world, actually every macro shock has implicit embedded monetary policy shock in it. So that changes how the economy and asset prices react to macro shocks. Okay, so before I get to the model, let me illustrate the main result, it's the setup and the main results with a few pictures, and I'm going to come back and redo this with equations. So the model is actually a fairly conventional New Keynesian framework. So we focus on aggregate demand shocks. So these are, like I said, shocks that move the expenditure in the economy without changing the potential output. And the twist that we bring to the New Keynesian model is the Fed actually needs to set the interest rate before observing these shocks. Okay, so the Fed is trying to stabilize output gaps. However, we make monetary policies a little harder. You don't see the aggregate shock that will hit the economy in this period when you set the interest rate, right? So that means that you cannot stabilize things state by state, but you can still do it on average, and that's what the Fed is going to do, right? And we think this kind of like interest rate setting under uncertainty is actually quite realistic, because and unlike in the textbooks, but it's actually, I think, a quite realistic assumption, because in practice, when you do monetary policy in real time, right, it's hard. You don't see the economic activity, you don't see inflation, you don't see output. Basically, all these real-time measures are not available. You're kind of operating a little bit in the dark. You need to make assumptions about what you think those things are, and that's kind of what we put into the model. Alternatively, in practice, there are large lags between when you set the interest rate and when that interest rate starts affecting the economy. And we can, there are many reasons for these lags, but they're quite natural. And again, the lags would also imply you kind of need to think about the future where things are uncertain and how the conditions will be by the time your currency policies will take effect, right? So that's kind of our timing assumption, what it captures. And for our purposes, why does it matter? Because it makes Fed's beliefs relevant to monetary policy, right? The Fed will stabilize things on average according to its own belief. Now, we also make the market disagree with the Fed about the aggregate demand shock. And that creates the core tension of the model, right? Because the market thinks the Fed is doing a mistake, right? Because the market thinks the Fed should be stabilizing things according to the market's belief. By the way, think about this. This is a completely general feature of disagreement. Whenever two people disagree, whenever you and I disagree, I think you are doing a mistake, because whatever you're doing, I think you should be doing under my belief, right? For certain things, it doesn't matter. Maybe I think you should be eating healthy. If you eat other stuff, like, okay, I think you're doing a mistake, but it doesn't affect me. But when you disagree with the Fed, it has actually potentially bigger implications, because what the Fed does affects everyone, right? So basically, that's the core tension of the model. The market thinks the Fed makes monetary policy mistakes, and the whole model is understanding the implications of these mistakes. Okay, so.
Hi, Pojam. This I think reminds me of Sundaram and Stein paper, where they put the long rates into the loss function. And they asked whether if the Fed should be responding to the volatility in the long rates. So can I interpret this in this sense? I know that they have information asymmetry there, but is this something that you're willing to capture here as well?
This is different, and we're going to reach, well, I think we are asking, we are interested in orthogonal issues. So in there, they think the long rate enters the Fed's objective function because of financial stability type issues. And then there is a signaling element. So you're sort of trying to change the interest rate less because you're trying to stabilize the long rate, but it backfires because the market. So they reach the conclusion that you should ignore what the market thinks about your rates. We make different assumptions and reach different conclusions. In fact, in our model, you need to pay attention to what the market thinks and should. So actually, it's quite different than their paper. We can talk about the differences later. Okay, so the core thing here is that the market thinks you should be setting a different interest rate, because the market thinks you should be doing this stabilization according to the market's belief. Now, if we only had a static model, it wouldn't be too big a deal. So the market thinks you're making a mistake. They would be grumpy, talk to the newspapers about how the Fed is doing a poor job. But that's it, right? So you can ignore the market and still do the right thing according to your view. But things are a lot more interesting in a dynamic framework, because when you add some dynamics and when you assume beliefs actually are somewhat persistent, which is natural, right? Even with Bayesian learning, if we disagree now, some of that disagreement will persist into the future. Now you see the market thinks not only the Fed is making now a mistake, but it will continue to make mistakes in the same direction also in the future, right? So if the Fed is like too optimistic, and I think as the market think the Fed is setting too high rates, inducing a negative, the Fed is too optimistic, setting too high rates and inducing negative output gaps, I continue to think the Fed will make that kind of mistake in the future. And that matters even for current economic activity, right? Because the markets are forward-looking. So if they expect the future monetary policy will do a poor job and induce negative output gaps, that actually lowers the output gap immediately, right? So this becomes like an endogenous aggregate demand reduction that you kind of have to respond to. So the result that we have is that even the Fed disagrees with the market, thinks the market is completely crazy, you actually end up accommodating the market. You move somewhat to the market, because if you didn't do that, you would miss your current target. You do that because of these dynamic anticipation effects that kind of force the Fed's hand and force the Fed to move closer to the market. And how much you move close to the market depends on how confident initial beliefs are, right? Because that determines how much of current disagreements will persist into the future, right? In fact, precisely when the market is the agents are more confident, they're more stubborn and cling on to their initial views, that's when actually you give in more to the market and you move more to the market's direction. Yes?
Hocam?
Yes?
If I may. So I'm having difficulty following this. I mean, I would think that the market not following Fed's view would lose more than the Fed not following the markets. So, I mean, what's the benefit of the market disagreeing with Fed and not believing what they're saying is right?
Oh, that goes to our basic assumption that the Fed, these disagreements are not informational. So, I mean, you already see everything the Fed sees, and everyone sees everything that the other guy sees. They reach a different conclusion. So when I reach a different conclusion, of course, I don't follow what you say because I think you're making a mistake, right? So I think you're going back to the information framework, because that's, I think, kind of like the usual assumption, but we are departing from the usual assumption. These are disagreements. These are genuine disagreements. I think if I think, let's say in 2000, let's go back to the example of 2007. The markets think actually financial frictions are more severe at the time, and the Fed doesn't understand it. They don't understand the scope of the problem. Why should they pay attention to the Fed? They think they know it better, right? So and they still pay attention to the Fed because the Fed sets the monetary policy, and in fact, what that means is that they think is that the Fed is going to keep interest rates too high and won't be able to stabilize the economy. So that's what they react to. Okay, so they think the Fed is going to make a mistake, set too high interest rates, and that's what they react to, because they don't think there's anything to learn from the Fed. But if they think the Fed is doing a poor job and setting the wrong interest rates, and that's what they react to. Okay, so that's like going to the core of the model. The whole model is sort of built upon the idea of disagreement as opposed to information. If you don't like that, of course, then this is not the paper for you, because this is not the assumption that we're going to stick to. Okay.
May I make a quick comment while we are here? Back in 2012 and 13, there was a big difference between what the Riksbank was publishing in terms of the endogenous interest rate path and what the markets were saying. There is a long literature led by Lars Svensson on that. I can't remember where it ended up, but I think the Riksbank's final take on that, mostly after being convinced by Lars Svensson, was, could this be a kind of a source of shock, this massive difference that we were observing? I can't remember where that debate ended, but it seems very relevant to what you are doing here.
No, this is exactly right. I mean, this is exactly, I think, so basically when you see a gap between these two things, it operates like a shock, essentially, negative shock. And you need to kind of, instead of following your view, move a little bit closer to the market to step. That's the policy implication of our analysis. Okay, so it's a, and I think, by the way, if you talk to the Fed people, you see they do feel this pressure from market. When the market wants a certain rate, and if you don't give it to them, you'll see an adverse reaction in financial markets. And that's what our model captures. Okay, so that kind of forces the Fed's hand in practice, and that also forces the Fed's hand in our model as well. Okay, so how do we explain the motivating fact, the gaps between the dot and the forward curve. Remember, our result is that you set a weighted average of the two views. The Fed doesn't fully follow its view of demand. It's actually putting some weight on the market's view. Okay, so let's take that weighted average rule and let's think about what this implies now for the dot curve at period 1. So what is the dot curve? It's the the Fed's expectation for interest rates. The current interest rate, the forward curve is the market's expectation for the expected rates. And the current rate they agree on because everyone sees the short end, they all see the current rate. But they, in our model, expected rates in the second period in the future actually naturally differ, and we get the gaps in the model. Well, why is that? Well, that's related to learning, right? Because what does the Fed think here? The Fed thinks that, well, the market disagrees with me, but I'm right. And the market is learning from data, and the data will validate me. When we get the data released between periods 1 and 2, by the time we reach period 2, the market will see the data. They will see that I'm right. They will move closer to my view. They will, in this example, become more optimistic. So I will be able to set actually a rate that reflects relatively more my view. That does the market think. The market thinks the opposite. The Fed is kind of confused now, but we are right. And as the Fed sees the data, they will start to see the world like us. They will, in fact, in this example, become more pessimistic, move closer to the market. And the market thinks the future rates reflect relatively more the market's belief. Okay, so basically, disagreements and learning provide a very natural explanation for these gaps. And let me emphasize that actually you need learning as well to get these facts. The disagreement alone doesn't get you it. You need learning because something needs to change in the future for the policy rate to change. And each agent thinks that the other guy's belief will change in the direction that they think is right. Okay, so.
May I ask, doesn't this make monetary policy less potent in the sense that if there is a shock in a standard model, it works the standard way. If there's a shock here, then the market participants are going to perceive this as a very short-lived deviation because the thinking is, they're misguided and they're going to realize that they stupidly changed the policy and they're going to, undo this. Therefore, the impact on long rates is less, the impact on activity is less for any given shock.
Exactly. So say again. So it was your question was about if it's a short-run shock, like the duration of the shock.
The question here is the markets. So the markets will perceive this to be short-run shocks because they attribute the shock to the Fed's wrong opinion, and will think that the Fed will learn the right outcomes, right? And therefore undo the policy change, so to speak. And therefore, from the market's perspective, all shocks become more transitory deviations from the baseline policy.
You're exactly right. Not all shocks, but these disagreement shocks that when the Fed becomes more optimistic, actually that's a short-lived shock. And how short-lived depends precisely on confidence. That's like, I'm going to show you that. When the agents are more confident, they cling on to their views more. Actually, the shock is more persistent. But when they're less confident,
the point here then is this makes the monetary policy. This makes the monetary policy less potent, in that, I tell you, look, I'm not going to raise interest rates, and you say, well, you're saying this because you stupidly think things will continue to be bad, but we think it's going to be good. You will see that, and you will raise interest rates.
Yes.
Right. So my expansionary policy is perceived to be less expansionary than it's intended to be, and therefore the transmission to the real economy is going to be weaker.
Well, that's exactly right. I think our model, I want to postpone this discussion to after we see the model, because when we see the equations, I think that will become clear. In fact, the mechanisms that you describe are exactly in our model, and they actually determine how much you kind of have to move close to the market or not, or how much you need to accommodate, because they kind of capture how big a mistake there is. So the extent of the mistake is how much you need to move to the market.
Alp, can I jump in, because it's related exactly to your assumption, my question here. I mean, so this disagreement plus learning is a nice framework, but does the empirical evidence support it? Because when I look at the difference between the Fed expectations and the market expectations, you showed this chart at the beginning of the presentation, and the agreement is always on the same side.
Oh, okay, that's a great point. So yeah, I really wish that because we plot the dots, and as it happened in the last several years since the dots are released, the Fed has been predicting higher interest rates. But actually, I wish there was a flipping of that. But actually, if you look at earlier years and use, and we don't have the dots for those years, but let's say you use Green Book staff assumptions with all the caveats that the Fed mentioned. Actually, there are times where the Fed is more pessimistic than the market. Like let's say early 2000s, the Greenspan Fed was predicting lower interest rates compared to the market. They kind of understood the recession earlier, and also the sort of the follow-up of the recession, they were more pessimistic. So they do flip. They don't flip very often, which, by the way, I'm going to show you some empirical evidence that suggests these views don't change very quickly. So there's, I think, an empirical question of how persistent these views are. My sense is that they are quite persistent. They last several years. They don't last forever. So, you know, somewhere in between, right? But it's not that the Fed is always more optimistic or pessimistic. There has been times where the market was more optimistic than the Fed.
Okay.
All right. So let me say a word about related literature before I get to the model. So we are related to this information literature. Like I said, our key assumption is that we focus on disagreements as opposed to information. And we're also related to the literature on optimal monetary policy beyond rational expectations. And that literature, like by Woodford and others, typically assumes the market has some bounded rationality or maybe irrationality, and the Fed is rational and is trying to set the policy appropriately to correct for the market's mistakes. Actually, our model is different because, and first of all, we don't take a stand on who is rational, but actually in our model, the market thinks they're right and the Fed is making a mistake. So the market thinks the Fed is behavioral. And in fact, the whole paper revolves around the market's perceived mistakes and our Fed's reaction to that. So this leads to a very different analysis and very different results. And finally, there is a big literature that looks at these disagreements in macro and finance. Actually, the finance people are quite buy this assumption of disagreement quite easily, because that helps to understand why there is so much trading volume in financial markets, and that helps to understand many features of financial markets. And that actually, the literature focuses on disagreements among market participants, and I've written in that literature. But what we are doing here is basically looking at differences between the Fed and market. Okay, so that's the distinctive feature right to that literature. So before I get to the model, let me actually try to show you some facts. I see some of you are skeptical on these disagreements. Let me try to show you some facts from blue chip financial forecasts that we think support this type of disagreement, the assumption that we make. Okay, so this is a monthly survey of financial institutions and about future interest rates and about economic activity. And here I'm plotting the predictions for the Fed funds rate, which we take as the policy rate, okay, at a 1-year horizon. That's the top panel. And I'm also at the bottom panel plotting predictions for inflation at a 1-year horizon. And I'm doing it for the consensus. This is the green is the consensus prediction, and the blue is the Goldman Sachs prediction, and red is the Bear Stearns prediction until they failed in early 2008, right? So the first thing that you see in this picture is that there is actually some correlation between predictions about inflation and predictions about interest rates. We're going to take the predictions about inflation to be a proxy for aggregate demand, okay, which is what we use in the model. So you see in early 2000s, these institutions, the Fed and Goldman Sachs and Bear Stearns, were more pessimistic in terms of inflation aggregate demand expectations than the consensus, and they also predicted lower interest rates. And at some point, they turned more optimistic relative to consensus, and they predicted higher interest rates. And actually, right before the financial crisis, Goldman Sachs turned more pessimistic about aggregate demand and predicted lower interest rates, and Bear Stearns remained optimistic and predicted high interest rates until it failed in early 2008. And Goldman continued to predict actually weaker demand and lower interest rates subsequently. So that's kind of, we think, support our assumption that some of the interest rate disagreement is related to aggregate demand disagreement. Okay, so, but the more interesting thing that I take away from this picture is that these disagreements are quite persistent, right? So this is what I was trying to say to Hakan earlier. So you know, actually, these are like professional forecasters, and these are monthly releases, right? Blue chip. So there's no question that these guys have access to blue chip. So they see the consensus prediction last month. They see everyone else's prediction last month. Still, they stay with their own view, right? So you think if there are some dispersed information or something, consensus would aggregate that. So once I see the consensus, I move to the consensus. That doesn't happen for sure. They remain with they remain optimistic. They think the other guy is making a mistake. You know, that's my interpretation of what's going on here. And going back to my conversation with Hakan, so it's not that they're perpetually optimistic or perpetually pessimistic. So if you do a regression here and put fixed effects, you don't get much. It's more like they form episodic views. Okay, so they like for several years become relatively pessimistic and then become relatively optimistic and so on. So for instance, if you do a regression analysis, everything I showed you in that picture actually hold up systematically. And what you see is that if you want to predict someone's forecast for next month, the best predictor is what they said the last month. Okay.
Sorry, can I ask a
yes?
Can I ask a question related with the previous graph? When I look, I mean, it seems like there are similar percentages, but it seems that the market has more disagreement regarding the inflation, and when it comes to federal funds rate, they are more in agreement. But we think that the federal funds rate is influenced by, and in your model you said it will be like that, is influenced by demand estimates. So how does it come that they converge more when they're forming inflation expectations about the Fed funds rate? It's more in line. The variation is less compared to CPI, the GDP deflator estimates.
So that's a great question, and you know, this is a qualitative paper, so I don't have much to say about magnitudes here, and you know, but I should say one thing, that the scales here are different. So actually, you know, like a 1 percentage point, and you know, we kind of see the magnitudes are not small, by the way. Here, like you can see almost like 1%, even at the 1 year horizon, 1 percentage point different in expected policy rates are, I think, quite big, and you know, here it's comparable. But you're right, there seems to be more disagreement about inflation. And you know, another thing I should say is that I don't want to oversell this. If you do a regression, you find that GDP, the inflation predictions are correlated with the interest rate predictions even after time fixed effects. But the R square is not huge. There's clearly other things happening that we don't have in the model. Okay, so but this is just sort of a motivating assumption to say that qualitatively, at least, the feature that we are going to put into the model makes sense. But I agree. I take your point. I think there are issues with. I mean, our model is not going to capture everything that make people disagree about that.
Okay, thank you. Thank you.
Any other questions? Okay, so let me move. Of course, these are disagreements among the market participants. We're not looking at the Fed versus the market, but you know, our presumption is that the disagreements between this you see between major institutions can or at least plausibly carry over to the disagreements between the Fed and other market participants as well. And that's what we are going to build a model has that feature. And the model, other than this information assumption, is actually quite standard. And the paper I sent last week was actually a lot more complicated, but recently we have actually simplified it. And actually it's a very standard Newtonsian framework. Like what you find in Galli's textbook, or Clarida Galli-Gertler. So the market has standard preferences, and there are firms that use labor to produce, and we are going to assume for now prices are fully sticky. We can relax that. In fact, we think relaxing that will lead to additional interesting results. We can talk about that later. But for now, to keep things simple, full price stickiness. So what that means is that output is demand determined, right? So the spending of the representative household determines the output in the economy, basically. And by the way, what we call the market is basically the representative household. Okay, so and the one feature that we have in the model, again, standard, is aggregate demand shocks. So we assume in every period you get news about next period's productivity. Okay, so when you come to period T, actually the supply or the potential output AT, the productivity is determined already. It's determined in the last period. But what you don't know is the productivity in the next period, and you're going to learn that. And if it's good, it's going to be like good news, which will raise expenditure. If it's bad news, that will lower expenditure. Okay. In particular, if you solve this model and log linearize, you get a very standard IS curve, and the current output gap relative to potential or current output depends, among other things, on this G, right? Expectations about the future, positive expectations increase output, more expenditure, more output, negative expectation. So there's demand shocks, basically. G and captures demand movements for a variety of reasons. And otherwise, it's a completely standard IS curve, high interest rates, lower expenditure. And importantly, expectations about future enter this as well, right? Why? Because when you expect the future output or output gap to be higher, all else equal, the future is better, so you spend more now as well. Okay, so this is standard. Here is what's different. Sort of when the monetary policy sets the interest rate, and in fact that's the only difference from the textbook model. Okay, so we divide the period into two. Every period we divide it into two phases. There's a pre-shock phase and a post-shock phase, and the Fed sets the interest rate at the pre-shock phase before seeing the shock for the period, and then the market sees the shock and moves last and sets an output gap. Okay, so that's really the only twist relative to the textbook model, right? Okay, and what this means is that because you need to set interest rate like before you observe the shock, you cannot stabilize output gaps on average. We still sort of make you solve a standard gap minimizing problem, but because of uncertainty, you don't set it to zero state by state, which is what you would do in the textbook model if you set the interest rate here. Instead, you set it to zero on average, and importantly, under your own belief, okay, under the Fed's belief. And that's really the only twist. If I remove this expectation, you would have the textbook Gali model, right? So that's the only difference. And in terms of the notation, let me say here, we use E bar because we have these two phases to denote the expectations at the post-shock phase at the end of the period, and E, the expectations before the shock. Okay, so, but notice that actually the expectations at the post-shock phase is the same as the pre-shock expectations in the next period, because there's no news between the periods, right? So I can do everything just in terms of using one expectation operator, which I'm gonna do going forward. I'm gonna only use pre-shock expectations. Okay, so I'm gonna write everything in terms of pre-shock. Every E that you see in the rest of the slide corresponds to expectations in the beginning of the period. Okay, so right. All right, this is the model basically, right? These two equations. So this is the IS curve, and this is what the policy does. Okay, so that's the model. So when you solve this model, essentially, you can take the expectations of this according to Fed and set to zero. You can find a closed form solution for the interest rate, right? So, and what you find is that the interest rate the Fed sets depends on basically two things. The Fed's expectations of aggregate demand. When the Fed expects aggregate demand to be higher, it sets a higher rate. But importantly, it also depends on the market's perception for future gaps, right? Why? And that's kind of how disagreements and will enter our analysis, because in a model without disagreements, all these gaps are zero, right? In this model, we don't have inflation, we don't have, it's like divine coincidence. So you can set all the gaps to zero. So that term would be killed and you would get something completely standard. So what's different here is that the market might think the Fed might be doing a poor job of monetary policy and might think the gaps, therefore, will in the future will be negative or positive. And that actually affects the current spending, and that affects the Fed's current interest rate decision as well. The Fed needs to pay attention to that because otherwise you miss your target. Okay, so that's really the core of the kind of the tension in the model. And you can also solve for the output gap in this model state by state, right? And by assumption, the Fed stabilizes on average, but state by state things are different, right? If the demand shock happens to be higher than what you thought when you set the interest rate, then the output gap is higher. If the demand shock turns out to be lower, output gap is lower. But there is this other term here, but don't worry about that for now. I'm going to come back to that later, right? But these are basically the closed form solution for this model that that applies quite generally. What we're going to do is we're going to solve these equations for a particular specification of beliefs to understand things a little better and to make additional predictions. So we're going to specify agents' beliefs and then feed them into the equations that I showed you. Okay, so and here is the kind of situation that we envision for beliefs. There has been, remember, this G shock is a shock, it moves around. V is the transitory shocks to the demand, right? So there is always some transitory thing that moves demand. But we envision a situation where there has been a permanent shock to or somewhat permanent shock to demand. And if you want to make things concrete, suppose like we got news that there's financial problems. So, there's a permanent shock to demand. But we don't know how big that shock is, okay? So the U is an unknown parameter. And you and I have different views of this. Okay, so the Fed and the market start with different initial prior beliefs about what this unknown component or the persistent shock to demand is. Okay, so and that's kind of how we capture the disagreements. And what's going to be important in the model is like what you think in every period about the aggregate demand that's in that period. So I'm going to define that to be the mu, the conditional belief of aggregate demand. Initially, that's just given, right? That's just a version of U. But over time, agents actually will update their views. Why? Because every realization of output and demand here is actually a signal of the component that you're trying to, you don't know, right? So it's not a perfect signal because there are transitory things that move demand as well. But as you see demand, you're going to update your views. And eventually, in fact, you're going to learn this unknown component. But these disagreements, initial disagreements will persist for a while. Okay, so, and how fast you learn depends on how strong a prior that you start with, right? So it's like C here is a confidence of your initial priors. When C is bigger, you're going to learn more slowly, right? So in fact, the little c is going to show up in the formulas. Let me define that. So what is little c? So that's like relative confidence at a time s relative to a future time s plus t. Okay, so and in particular, if you do Bayesian updating here, you see the following. So my conditional belief about demand is a weighted average of what I thought the last period and the most recent realization of the signal, right? So I put some weight on the signal and some weight on my prior, and how much weight I put on my prior depends on this confidence. When C is bigger, I cling on to my priors, less on data. When C is smaller, I put more weight on data, right? So this is an illustration of how disagreements and learning evolve in this model. So in this example, the purple is the Fed's belief and the blue is the market's belief. Initially, they start with different beliefs. The Fed is more optimistic. And the black lines here show you the most recent realization of data. So when the data is negative, they both update negatively. When the data is positive, they both update positively. And eventually, they converge to one another, and they, in fact, converge to the truth. But they remain in disagreement for quite a while. And the solid lines here, when you start with sort of high confident beliefs, then you learn more slowly. Disagreements last for a long time. The dashed lines is when you start with sort of weaker priors, less confident priors, then disagreements disappear more quickly because like sort of you don't cling on to your priors, and everyone is looking at the same data. So in fact, they figure things out much more easily. Okay, so all right, so but here's something more interesting, again implied by Bayesian updating. Not only people learn in this model, agents learn, they actually expect the other agent to learn as well and come to their own view, right? And how do you see that? Well, so let's think about now the following. So let's fix a period one, and let's think about what each agent at period one thinks about the other agent's beliefs will be in the future periods. Okay, so the solid purple line here, what the Fed thinks its own views will be in the future period. Well, that's just a flat line because of like law of iterated expectations. Like what I think I will think in the future is what I think now, basically, right? So I don't think I'll change my view. But if you look at the purple lines here, this is now the Fed's current beliefs about what the market will think in the future periods. In period one, I see the market disagrees with me, right? That's just the market's current view. But in the future periods, I think the market will disagree with me less. I think the market's belief actually in the future periods will be much closer to my beliefs. Why? Well, because I think I'm right. And I think the data that's going to be realized in between is going to validate me. And I think that I know the market is Bayesian, as putting weight on the data. So it's going to move in my direction, right? So I think disagreements will decline in the future and decline in a particular way. I think the market will move closer to me. And the market thinks exactly the opposite, right? The market thinks it is right. So it thinks the data will validate its views and the Fed will move closer to its views. Okay, so that's in fact going to be the key kind of ingredient that will help us to understand the gaps. But that's actually quite natural implication of Bayesian updating and disagreement. Okay, so and those are basically all the things that you need to know about the beliefs. And I'm gonna show you in a minute what when you feed this belief into the equations, what the outcomes are and what the how disagreements affect the macroeconomy. But before I do that, let me start with a benchmark with common beliefs, just to warm up exercise. Okay, so suppose actually they start with the same beliefs, there's no disagreement. Well, then you have something completely standard, basically, right? The Fed sets interest rates according to the expected belief for aggregate demand, still output gaps are not fully stabilized because there is these shocks that you're not, you're setting under uncertainty, the interest rate. Positive shocks will move output gap upward, negative shocks will move output gap downward, but otherwise things are completely standard. And in this model, if you think about also, let's think about how the dot and forward curves look like. Again, let's fix period 1, and let's think about now how the future expectations about interest rates look like. If you basically take the expectations of this, you see, again, very standard expectations. So the dot and the forward curve are the same. There's no gap between them, and they both reflect the current views about aggregate demand, right? So when the people become more optimistic, and basically both curves shift up by the same amount, right? When they become pessimistic, both curves shift down by the same amount, right? So this is the benchmark. Now let me show you what happens with disagreements. Suppose, okay. Suppose actually, for now I assume they have the same confidence, so they learn from data in the same way, but they start with different beliefs, right? That's the disagreement assumption. So what is the equilibrium? So if you solve the equilibrium here now, you find the output gaps are very similar to what we had before. Still, the Fed is able to stabilize things on average. Shocks relative to Fed's expectations move stuff, but you're able to, by setting the interest rate appropriately, you're able to, by assumption, stabilize things. The disagreements manifest themselves in the interest rate that you need to set to achieve that outcome, right? Remember, previously, you were just setting the expected rate. Now you're not doing that. You're doing actually a weighted average of your expectations and the market's expectations. So even though the Fed sets the interest rate and the Fed thinks the market is wrong, it cannot ignore the market's views. You actually put some weight on the market's view as well, right? And that's one of the main results, right? You get this basically, and how much a weighted average rule, and how much weight you put depends on confidence. When agents are more confident, in fact, at the extreme case of full confidence, you completely ignore your view and you go with the market's view, even though you think they're crazy. Okay, so, all right. So, and how does the dot and forward curves look like in this model? Well, these equations show you the first one is the dot curve, right? The Fed's expectation for future interest rates. And the bottom is the forward curve, the market's expectation for future interest rates. And if you look at these equations that you see, they're primarily determined by the Fed's belief or the market's, the corresponding agent's belief. There is some adjustment to the other agent, but that adjustment dies down as you look into the future horizons. And if you look at the very long horizons, in fact, you just see the current disagreements about aggregate demand, right? And so let me actually show you these results in a picture, and also that helps to understand the intuition for the results. Okay, so this picture corresponds to, this shows you the forward and the dot curves in an example in which the Fed is more optimistic than the market. Okay, so so actually the dashed lines here is an initial state of affairs when they had the same beliefs. The solid line is the dot and the forward curve in the benchmark when they both become more optimistic, right? But the purple and the blue lines show you what happens when you make the Fed the more optimistic without changing the market's optimism, right? So that's just the Fed optimism effect. Now, what do you see here? Well, you see that fanning out of the two, right? And well, first of all, you see the first part of the result. Even though you make the Fed more optimistic by 1 percentage point here, the Fed doesn't increase the interest rate by the same amount. It sets a weighted average of its own view and the market's view, right? So that's sort of somewhere in between the two views. And you see the fanning out of the dot and the market curve. That's the second part of the result, right? So at the long end of these curves, you get basically the disagreements. But at the short end, they need to agree, right? In the very short end, they see the interest rate, so there's no disagreement. But gradually, the two curves fan out and approximate, in fact, the disagreements, the initial disagreements about aggregate demand, right? Okay. So what is the intuition of the result? Actually, so remember in this exercise, I made the Fed more optimistic and I didn't change the market's belief. So the market thinks actually interest rate shouldn't change at all. It should remain at this benchmark. But the interest rate do change, right? The Fed moves to the market somewhat. It's a weighted average, but it doesn't move all the way to the market. So interest rate go up somewhat. In fact, not only in the current period, but also in all the future period, the forward curve shifts up, right? And the market thinks all that shift is a mistake, right? Because the market's view in this exercise hasn't changed at all. So the market thinks the Fed is raising interest rates unwarranted. It shouldn't be raising interest rates. And so that puts downward pressure on the output gap in the current period. And that's why the Fed has to move somewhat to the market's view. If you didn't, you would miss your target. Okay, so, and if you look at the right-hand side here, now this is the case, the same exercise, but with Fed refed, going back to your question, this is now when they have less confidence, so they pay more weight on, they learn faster from data. Now you see it. In this case, the market thinks the Fed is making a mistake as well, but the market thinks the mistakes will disappear more quickly, and the Fed will come to the market's view more quickly. So, but that means that actually the Fed is less constrained now, right? Because there is less pressure in financial markets now, because the markets are on the economy now, because agents think the Fed is making mistakes, but these mistakes are going to go away soon. So there's not as much pressure on the current output gap, and therefore the Fed can live up to its expectations more, right? Can raise the interest rate more. So in equilibrium, it ends up raising the interest rate more, precisely when agents learn faster, and you stay closer to the market when agents learn more slowly, right? So, and also the speed of learning naturally translates into how fast these dot and forward curves pan out, okay? Because that's driven by it, right? So why does the Fed think the interest rates in the future will be higher? Well, because Fed, for the reasons that I showed you, thinks the market's belief will be closer to the Fed's belief in this period than it is now. And so even with the same weighted average rule, it will be able to set a higher interest rate. The market thinks the Fed's belief will come to its view, and the Fed will set even closer set interest rates that are even more reflective of the market's view.
I have a question about what the disagreement might be about. So here, it's directly about the level of activity. So that if we disagree, immediately we have to act on it. But we could, for example, disagree on the persistence of inflation deviations. And they only matter if inflation is deviating, right? So here at steady state, if disagreement happens, it automatically pushes us off steady state by itself.
Yes.
But assume we are disagreeing on inflation persistence. At steady state, the disagreement shock hits. As long as inflation is doing nothing, it's still irrelevant. And this has interesting, in your model, optimal policy repercussions, because it's going to affect the Fed's desire to stabilize the economy differentially, right? If we are disagreeing only on the persistence, and the Fed, of course, understands that disagreement itself is a negative shock, to make sure that the shock isn't realized by having inflation move around, it's going to crazy about stabilizing inflation.
So that's very. I mean, I need to think about that. I think actually there's. The way I see this paper is like a starting point. We put the simplest possible disagreement about aggregate demand, and I think there's a lot more to do. And I agree with you. Like if you start playing with the persistence of shocks, you might get interesting things. I think, although. I should tell you that I think actually even without doing that, if you put a Phillips curve into the model and just have disagreements now about also these disagreements start affecting inflation, that actually I think is already quite interesting. So I can tell you I have conjectures about that. We haven't done that because in that case, what the market thinks when the market thinks the Fed does a poor job of monetary policy, it affects economic activity. It doesn't affect prices, right? Because the prices are fixed.
Yeah.
But when the market thinks the Fed is doing a poor job of monetary policy in a model with inflation, it actually starts expecting inflation or deflation in the future. Right? In this example, actually, the firms would start, when they see the Fed has gone crazy and raises interest rates, they would start thinking that, well, there will be deflation in the future, and that actually automatically creates deflation now. And you get like, it acts like a cost push shock and it breaks the divine coincidence and interesting stuff.
An interesting question would be what happens when they disagree on the slope of the Phillips curve?
I agree. Yeah, I understood your question, but what I'm saying is that even before we get there, once you put inflation, interesting things happen. So we need to, I think, move gradually. First, understand like.
Fair enough.
I agree with you. I mean, in fact, it would be great to develop, I think, those types of implications, of further implications. But so we
actually, in addition to
this already got to us like interesting things that we think we can at least match qualitatively to the data. Yeah.
Actually, in addition to Refeto's point, there's a paper on Journal of Business and Economic Statistics about how forecasters disagree on perceived inflation persistence.
And the way it is identified is basically through revisions. So the paper looks at revisions and then looks at the persistence of revisions. And the paper's point essentially is they agree on the persistence of an inflation shock, more like the persistence of the inflation itself, but it's persistence of inflation shock. So there seems to be some empirical evidence there.
Okay. No, I mean, I think these are great questions. And, you know, one way of thinking about these things is that this is one way by which these disagreements come about, right? Like if you disagree about persistence of processes and when there's a shock, it will create a disagreement where there was none to begin with. That's like just, it could be a motivation for the disagreement we are assuming, but perhaps there is something more interesting going on. And, you know, I need to think more about it. But exactly, I think these are great questions. So sorry, let me actually show you. I think these thought experiments help to understand the model a little better. So let me actually show you now the reverse case when the market becomes more optimistic, but the Fed's belief doesn't change. Okay, so so again, starting from a common belief, I make the market more optimistic, and I don't change the Fed's belief. So what happens again? You get a weighted average. So even though the Fed's belief didn't change, it is kind of forced to increase the interest rates. It is set because it sets a weighted average. It sort of moves to some extent to the market's belief, right? And then there's a fanning out. The Fed thinks eventually it will be able to lower the rates back to where they should be, and the market thinks the rates will continue to increase. In fact, it will become even closer to their view. Okay, so now what's going on here? Well, the market has become optimistic, but the market sees the Fed doesn't really share that optimism. So the market thinks the Fed, even though the Fed is raising interest rates, the Fed is not raising interest rates fast enough compared to what it should be doing. Now the Fed is doing a mistake in the opposite direction, right? So the market has become bullish, but the Fed hasn't become that bullish. So they're not raising interest rates too much. So that kind of thinks the market sort of now thinks interest rates raised too little. So that creates a rally in financial markets and economic activity, right? So there's an upward shock to current output gap or current asset prices. And the Fed now is raising interest rates, even though its views didn't change, to dampen the aggregate demand impact of that shock. Okay, and again, when they are learning faster, there's the market thinks the Fed will catch up more quickly and raise rates faster. So in this case, in fact, the current shock is weaker, and the Fed doesn't raise interest rates so much. But when the views are quite persistent, you end up raising a lot, right? So this is the flip side of the earlier picture that I showed you. Okay. Now let me talk about some extensions. So actually, the first extension is when we have information asymmetry in addition to disagreements. Okay, so we think the Fed might know, at least for more than markets. At least the literature seems to think that. So let's put that into the model. So let's give the Fed a private signal in period 0 and only in period 0. And this is before they set the interest rate. Okay, so the Fed receives a private signal in the beginning, and the market actually agrees that this particular signal is informative. So there is some information effect, but on top of that, there is still the initial disagreements that I had earlier. Okay, so there's two of them. And otherwise, the model is the same. So if the Fed receives a signal, and in the future, there's no signal, the future model periods are exactly the same as before. Okay, so now what happens here? Now, if you here we have an equilibrium in which the interest rate is actually a one-to-one function of the Fed's signal. So the Fed's interest rate actually signals its information. So we have the signaling effect, emphasizing the literature. When the Fed sets a higher rate, all else equal, that means it has a high signal, and the market learns that. And when the Fed has lower rate, again, all else equal, so information is lower, and the market learns that, and the market incorporates that information. But remember, there is still some disagreement. So even after incorporating the Fed information effect, there's going to be residual disagreement, and so we still have the same results earlier. They're just weaker, right? And how much weaker? Well, if the information is infinite, then in fact you only have the information effect and you don't have our results. But as long as the information is finite, and as long as there is some initial confidence in initial beliefs, you still have our earlier results. Okay, so this shows our early results are actually robust, allowing for some information asymmetry. We just need to have some disagreement. We don't need to be everything to be driven by disagreement. But here is something more interesting. Now, actually, in this type of model where the Fed has some information and the market might actually agree with the Fed, it's quite, but also they have different beliefs for other reasons. It's actually quite natural to think that the market actually can also disagree with the Fed signal, right? So, I mean, just like they disagree with you on other things, maybe on this particular piece of information, they will disagree with you as well. And suppose the Fed doesn't know that, right? Suppose I want to set high rates because I have some positive piece of information, and I don't know if the market will agree or disagree with me, right? So there is uncertainty. So two results. First of all, you kind of discount your signal a little bit. The signaling becomes weaker because you don't quite know if the market will buy the signal or not. But second, and more interestingly, when the Fed actually sets the interest rate in an attempt to signal here its information, you can get two different reactions depending on the market's type, right? Because when the Fed sets the interest rate, and then we're going to figure out basically the market's type from the reaction that they give to this. And depending on the market's type, you get two types of reaction. Either the market turns out to be an agreeable type, in which case they buy your signal. And then you have an information effect. Actually, asset price and output rallies, because remember, you kind of discounted your signal a little bit. But if the market turned out to be agreeable, essentially you set interest rates too low, and the market now sort of becomes more optimistic, and there's a boom. But if the market disagrees with you, actually, then you have the opposite situation, where you release the signal and the market says, turns out to be of the disagreeable type, and in fact, you set the interest rates too high, and relative to what you should be doing, and in fact, there is a negative reaction in financial markets and output. So we think actually this kind of helps to understand when the Fed announces policy, most of the time you have the usual reaction, right? There's like what the literature call monetary policy shocks, asset prices decline or whatnot when there's a surprise increase in the policy rate. Well, that happens here in our model when the market is of disagreeable type, but sometimes you have the information effect, right? And that also happens in this model when the market turns out to be of agreeable type. So you can basically have both reactions simultaneously in the model. I think that's interesting because that helps you understand how you are getting one versus the other reaction. Empirically too, sometimes when interest rates go up, asset prices go up. That's like those are information events according from the lens of these models. And these are disagreement events, right? Another thing I want to say here is that I think this model also helps you understand kind of at a deeper level what a monetary policy shock is, right? What is a monetary policy shock in the literature? The Fed wakes up and decides to set interest rates too high. I never understood what this is supposed to mean, right? So there needs to be a reason why the Fed is setting high or lower rates. So, I mean, I can understand the Volcker because that's sort of the attempt to lower inflation. But, you know, for more recent years, which the literature looks at this information, so the policy shocks, and it's unclear why, you know, kind of the Fed is randomly setting a higher or lower rate. In this model, you understand why they're doing that, right? The Fed is doing that because they're optimistic compared to the market. And that's like what a monetary policy shock, and the market disagrees with them. That's what a monetary policy shock is from the lens of the market. Okay, so, and by the way, how this affects the economy, I think there are actually quite subtle issues here, because how this affects the economy eventually, like this is the expectations, we can tell what happens. And probably asset prices will affect the expectations, but how it actually affects actual outcomes, which is what the empirical literature looks at, right? You look at the monetary policy shocks and how they affect actual outcomes. It's quite subtle. It depends on whether the market is right or the Fed is right? So I think there's quite an interesting set of issues to think about here, what the meaning of the monetary policy shocks and also the empirical regressions that people run on output on monetary policy shocks. But we are not quite there yet. Okay, so in the remaining time, I want to show you now another extension where I'm going to actually not only have disagreements, but also heterogeneous data sensitivity, right? Remember, this confidence parameter controls how much weight you put on the data. And on the earlier results, I assume this was the same, just to focus on disagreements. Now let me make it different. And so what happens, so in particular, let's just focus on a situation where the Fed is less confident, so it actually puts more weight on data than the market, right? So what happens in this type of model is that even if you start with the same beliefs, you might actually have disagreements generated endogenously because people react to the data differently, right? So when they start with the same beliefs here in this example, when the data turns out to be negative, because the Fed puts more weight on it, the Fed becomes more pessimistic. But then when the Fed data becomes more positive, now the Fed becomes relatively optimistic, right? So basically get disagreements actually become endogenous now and they become volatile, right? So actually, remember these disagreements are deriving the perceived monetary policy mistakes. And now these mistakes become stochastic. So that actually generates interesting effects because every macro shock now comes with an embedded monetary policy shock, right? Depending on how the Fed will react to that. So in this example where the Fed is reacting to data more, a positive shock means actually it comes with it, bundled with a positive monetary policy shock, mistake shock as well, right? So when there's a good news, the market thinks, wait, this will make the Fed more optimistic, and now they will raise interest rates too high. So there's a endogenous negative monetary policy shock that coupled with it. Okay, so that's coupled with it, and this changes if you solve the model actually how demand shocks affect economic activity as well as asset prices. So so previously you had a coefficient of 1 here, right? So demand shocks moved only because the shock was bigger than what the Fed expected, or what the shock was worse than what the Fed has expected, and the coefficient in front of that was 1, right? Now that coefficient becomes different than 1, and it's less than 1 precisely when the Fed is more data sensitive, right? Why? Because when the Fed is more data sensitive, good news are not exactly good news, because they're good news on the one hand, but at the same time, they make the Fed more optimistic, and they create this too much interest rate increases perceived by the market. So they come bundled with a little bad news. So you end up getting a smaller, more muted reaction on output gap and economic activity, right? So conversely, when the Fed is putting less weight on the data, let's say when the Fed is more confident, C is bigger, then actually you get the reverse result that D becomes bigger than 1. In that case, actually, good news are bundled with positive monetary policy shocks, right? Not only there's good news, but actually the Fed hasn't really become as optimistic as the market. So actually the Fed is not going to raise the interest rate as much as it should, as perceived by the market. So, so this will actually generate a doubly positive impact on economic activity and asset prices, right? So anyway, I'm showing here results for the output gap because the model thinks in terms of output gap. But it's actually easy to do asset pricing in this model. Let's say there's a market portfolio, which is like claims on or proportional to output. The price of that would move in proportion to the output gap. So you can get the empirical predictions here, I think, are sort of, you can think of it like stock prices when the Fed is more sensitive will react to news, will give more muted reaction to news. And when the Fed is less sensitive, will give bigger reaction to news, right? So we think these are actually somewhat testable predictions, right? So actually, let me show you in this case where the Fed is more data sensitive, how does the forward and the dot curves look like? Because I think that also helps to understand a bit better the result that I just showed you for output and asset prices. So again, the exercise is we initially basically everyone agrees, no disagreement. And here the exercise is, suppose initially there's a positive shock, but so that will generate optimism. Both agents will put some weight on the positive shock and will update their views, but they update differently. And the Fed updates more than the market. Okay, so what do you see here? Well, first you get something like a common optimism shock because there's positive news, and everyone is putting some weight on that. So both the dot and the forward curve shift up to some extent. But because the Fed puts more weight on it, the Fed becomes more optimistic than the market. There's on top of that a disagreement shock, like I explained earlier. So the dot curve actually shifts more than the forward curve, right? And all these additional increases, according to the market, are mistakes, right? So the market thinks there's good news, and the Fed is raising rates, but they are raising rates too much. So the good news, even though it moves the economy, it always moves the economy in our model, it moves it less, right? Because it comes bundled with these, a path shock, if you want to, too high interest rates into the future. And so you get a muted reaction. By the way, we used to play, you can play with versions of the model where you change the belief structure. You can even make the good news become bad news, okay? So it doesn't happen in the model that I showed you, but it is a theoretical possibility that there's gonna be good news and the Fed will become so optimistic that actually that monetary policy reaction, shock effect will actually swap the direct effect and you get a negative reaction to good news. That doesn't happen here. You just get muted reaction when the Fed is more reactive. So, and conversely, when the Fed is less reacting, you get an amplified reaction. Okay. By the way, another thing I want to say here is that, you know, I think there's an issue of how to identify these belief regimes or how much weight the Fed puts on data versus the market. But one place that looks kind of similar to the model, although it's different, is like the zero lower bound, right? Or some constraint. When the Fed faces some constraint, it is as if the Fed is more confident. It's not really more confident. It's like an as if mapping. But when there's like basically a constraint on the Fed's policy, interest rates are not changing much, even though shocks are happening. So it's in our model as if the Fed is not changing its view, even though the shocks are happening. So that case, we get actually amplified reaction, right? And for quite intuitive reasons, right? So there's a zero lower bound, the good news happen, and the interest rates don't really react to that. So you basically get an amplified reaction, right? So that's kind of one way of at least mapping this to data. But I think the more interesting way to map is try to identify these different data sensitivity regimes and try to test the predictions. Let's say by looking at how stock prices react to macroeconomic releases, and you know, so does it like line up as the model thinks it should line up? And the Fed is more sensitive, they react less and more otherwise. Okay, so
and I think it was the other way around, right? So the Fed was keeping the interest rate zero for a long time, but the market consistently thought that zero lower bound would be lifted in 4 to 6 quarters or something, and which lasted 10 years essentially, more or less. Right. So the markets were always more optimistic than the Fed.
I agree with you, and this is an answer to the questions of how can be disagreement, because if you look at, in fact, you see it in the picture that I showed you earlier, the blue chip, the average blue chip forecaster was predicting interest rate hikes in early 2000s, way before the interest rates were actually lifted, and that's the average. In fact, some participants were predicting very large interest rate, very quick interest rates increases. So you're right. But still, I think the zero lower bound, because it is a constraint, it does sort of put a limit. I mean, for the participants who think interest rates will lift up, maybe it wasn't a constraint, but I would say for still on average, it was a constraint, and it, you know, it sort of mutes the reaction. For instance, to negative shocks, it's very clear, right? For a negative shocks, the Fed won't be able to react to that. And you think that now will affect the economy a lot more. And on the upside, maybe some of the participants who thought as no longer a constraint, actually it wasn't, but for the average, for the market price, I don't know. I think the market prices arguably were still pricing the zero lower bound, but yeah, I think those are, I agree with you that it depends on whether the market thinks there's a binding constraint or not. Exactly. Okay. All right. So let me conclude, and then maybe we can have a discussion. So motivated by the differences between the dot and the forward curves that we see in the data, we build a model in which markets and the central banks have disagreements, confident, opinionated disagreements. And we find that with some learning, these disagreements actually provide a natural explanation for the gaps between the dot and the forward curve that we see in the data, but they also matter for optimal monetary policy. They matter for the current interest rates as well, because the market expects monetary policy mistakes, and the Fed needs to react to that, because if you don't, then you miss your target, because the market's perceived mistakes create pressure on economic activity and financial markets, and you need to react to that to stabilize the economy. By the way, I should have said this a long time ago, but we put in this paper these mistakes in quotes because these are mistakes according to the market's belief, right? These are not mistakes according to the Fed's belief or the objective belief. So these are perceived mistakes. And this whole paper is revolving around what these perceived mistakes imply for optimal monetary policy and macroeconomic outcomes. And by the way, I think there are some natural extensions of what we are doing, you know, in other policy areas as well. So you can think about maybe mistakes in other policy making, right? So if the markets think Trump is going to do a poor job of COVID, and maybe it's sort of reflected in financial markets, and then maybe Trump needs to move to, that's a very stylized example, but just to illustrate, the concept of a policy mistake we think is actually a lot more general, but in this paper we applied it to the Fed. And we also, in an extension I've showed you, when you have signaling together with disagreement, you basically get interesting effects that happen around monetary policy announcements. When the Fed is trying to signal its information via interest rate, you can get an information event where the markets and activity rally, or you can actually get a mistake event. The market actually thinks this was a wrong rate hike, and you get the economic activity to decline. And in the data we see both, and the model provides a way of interpreting these both things. And finally, with heterogeneous data sensitivity, heterogeneous learning from data, we see shocks are bundled with monetary policy mistakes, because every shock also changes the extent of the mistake, right? So even if you set the interest rate to insulate the economy from the average mistake, you know, as the shocks make those perceived mistakes bigger or smaller, you're going to get kind of according to the market, too high or too low movements in interest rates, and that will amplify or dampen the direct impact of the shocks. Okay, so let me stop here, and I'm happy to take any questions that you have.
Jim, I have a policy question. So this all seems reasonable, and you know, I can easily believe, I do easily believe that I live in a world that is at least partially characterized with this kind of, you know, opinion differences and dynamics led by these. But then these are not preference differences. They really are opinion differences, and these are opinions of otherwise reasonable people. And so it's not very easy to imagine a world where those differences persist for a long time, right? Because if it really is, going back to the beginning of your presentation, what we talked about when I asked where are these coming from, right? So because you say, well, I put more weight on this, you put more weight on that in forecasting inflation. That really is an empirical question, and we can hash it out.
Well,
so
where do they come from? I agree, Refet. And I think this is why the literature has sort of focused on rational expectations. These are like professional, but my own view is disagreements don't go away. As much as we would like them to go away, they don't go away. I mean, I saw you the survey data. Disagreements are huge, and they don't go away. And those are for we're sort of talking about Bear Stearns and Goldman Sachs. They're both like financial institutions with a lot of resources, and yet they come to different conclusions. Now, why?
So my point here.
Say again.
So my point here is, you know, the opinion differences that we see are less likely to be these transitory events.
Oh.
Right. So they really are more likely to be fixed effects rather than things that we learn over time. Right. So that's the thing.
I see.
The things that would be the transitory, or you know, you look here, I look there, we hash it out. Those things go away very quickly. The differences that we see so persistently in the data is, I fundamentally don't think the Fed can solve this problem. And nothing the Fed does convinces me otherwise. But kind of differences.
Yeah, I think I have two answers to that. First of all, the macroeconomy is changing all the time, and we are hit by shocks, original shocks that we hadn't seen before. Like, take the trade shocks, trade wars, right? I mean, yeah, maybe you can look at history to learn something about trade wars, but really it's like, you know, no one has a clue how the trade wars will affect the economy, right? People can have, reasonable people can have quite different, legitimately quite different views about the fallout from trade wars, I think. And no empirical analysis will resolve that question. So I think there's actually quite natural, because the economy is always, and then COVID shock. This is something that like happened, something similar to happen 100 years ago. So I think, and in fact, that was quite different. So I think it's a quite, and in fact, I would think it's actually much more natural to think people will disagree about how long this will last and how big and it will affect the economy than they agree, right? So, and then we get always different shocks, and they have different nature. So I think quite naturally this generates disagreements. But actually, even we had similar shocks. I mean, these are maybe less applicable to the institutions, but what I see in, for instance, in finance and kind of when you look at micro data, trading data, or survey data, is people actually are not very good at Bayesian updating. So if you think like, let's say people are subject to biases and they're subject to biases heterogeneously, like someone has more of a confirmation bias than the other, or someone is more overconfident than the other, even with sort of plain vanilla shocks, you can get disagreements recreated even when they didn't exist, right? So those are like my two answers to your question, how I think about disagreements. But another answer is that they're just there in the data. As much as like theoretically they shouldn't be there, they are there. Like if you look at survey data and so on. So, and they don't seem to go away. So that's kind of an empirical answer.
Another point could be, I mean, another reason would be that I think this paper by somebody, I don't remember, is basically agents have different, they update their information sets at different times in the timeline. So they not all of them may not have the same. I mean, they have a lot of resources, but it could be that like the Caldwell theory, the information stickiness actually plays an important role.
Sticky information, right?
Yeah, something like that.
That's interesting. I mean, I need to think about that.
I was going to ask a question related to this actually. So I don't know how observationally different this will be to this type of a sticky information model. So here you assume everything that has to be seen is seen, but there's people interpret differently.
So let me say,
alternatively,
I think it's different, although I'm not 100% sure. The reason is that, so when you have sticky, by the way, I should say I find sticky information very realistic, right? So of course, these are not exclusive things. You can have sticky information. On top of that, you can have some agents disagree with the Fed. In fact, I have a paper that we use the sticky information for some things, but I don't think it would be the same as what we are doing here, because what's important is that actually markets sort of actively react to what the Fed is doing. Right? So if the market sort of, like the Fed became more optimistic, but the farm market hasn't caught up yet, that wouldn't put pressure necessarily on asset prices and output. And, I mean, it depends on how we model the information, but if their portfolios are passive or people's consumption is just predetermined, you don't see the pressure. And then the whole thing about this paper is that the market actually perceives a mistake, acts on it, and that forces the Fed's hand to react and kind of move closer to the market, right? So I don't think you get similar results if you do it with sticky information. It's actually important that the market actively disagrees with the Fed and takes an action against it. But I need to think more about it. But independently, I think that's another interesting friction to explore.
But if you really persistently do not update your information, right?
Yes.
That difference can stay for a while.
I agree, but you wouldn't necessarily also react to, because you're not reacting to stuff in general. I don't think you would react to when the Fed becomes more optimistic. The Fed's optimistic.
But I mean, what you're calling market view is the average of the market. You could have a different distributions.
Yeah,
right?
yeah.
So
I mean, I agree. And what I'm saying is that the effects that I emphasized there are going to be driven by the guys that actively update and react to the Fed and price the Fed's mistakes and so on.
Sure.
The other guys are going to be kind of on the sidelines, and I don't think they drive the results here is what I'm saying.
Yeah, but I'm saying this because just looking at strictly within the model, these are households.
Right? Well,
and,
okay, I mean, yeah, this is a stylized model, right? So
stylized model, of course, I know that.
Yeah, but the way we think about these models, we think of that's why we call it the market. Because we think financial markets are the active guys, and they are the ones that react to monetary policy. And that kind of will spill over to the other guys as well. Like if someone is following just a very passive rule of spending according to financial market prices, they don't need to really think about what the Fed is doing, but the financial markets will do that for them, right? So, but we think of really the drivers of this as the financial institutions, people who have a view of monetary policy and disagree with the Fed.
And can I ask one more question, just related to this? So, what if you alternatively think of this as people with different rational inattention filters?
Okay, that's interesting. So that I think that now we are getting into the weeds of how you model really rational attention, but that could be one way of motivating disagreement, depending on how you do it.
In principle, you have the data, but it doesn't mean they actually see the same thing. You have that kind of thing going on in the model, right? So the weights are different, for instance. Meaning updating weights.
In a way, that does look like a version of our model where you put different weights on the data, like heterogeneous C, what I showed you. But what you need to make an assumption that you're willing to act, sort of against, or you ignore what the other guy is saying. That's like not in your information set or something. But
I mean, more like some firms are huge, some financial firms are huge. They probably have a finer filter compared to some smaller firms with a coarser filter.
Okay, that will generate heterogeneity among the market participants.
Yes.
But actually, now that I thought more about it, I think you still need the market participants to react to the Fed's information, the Fed's optimism event as well, right? Because the whole thing here is that the Fed, as a view, the market sees that and starts like pricing monetary policy mistakes. So you need kind of that, some agents to react to that. And those are the guys that will drive the results here. That makes sense. So I don't know, there might be ways of reinterpreting that rational attention, but I find our interpretation more natural, perhaps because I come from finance, where this assumption is becoming pretty standard actually. It hasn't made its way into macro yet, but the macro is kind of busy with rational attention, which is important. But I think on top of rational attention, there is also behavioral biases and disagreements, and all these things actually are relevant as well.
I mean, I'm not disagreeing with you here. I'm simply saying we can perhaps accept they disagree, fine, but also we want to think about why they disagree. That's why I was asking questions.
I agree, and this goes back to some of the questions we referred, but I should say, I don't think the insights that we have here, this is a highly stylized model, but I think the insights are generalizable. So this is why I don't take a strong position on where the disagreements come from, because my sense is that if you think through the logic of the model, essentially, no matter where the disagreements will come from, you're going to have these effects. You might have additional effects on top of that as well. So that's why, we're being a bit agnostic about the source of the disagreements.
All right. This was great. And we are over time. Alp Hocam, thank you very much. This was an early morning seminar for you. And thanks to the participants who are here and for a great lively participation. I enjoyed this a lot and learned a lot, and I hope this is mutual. Hocam, thank you so very much. Looking very much forward to seeing you in person soon here. And to everyone, have a good weekend. Be well, stay healthy, take care. Bye.
Thank you again. And for the invitation.